Right now, American households owe $1.28 trillion on credit cards, while the average interest charged on balances that actually carry interest was 21.52% in February 2026. Your money goes into the banking system at near cash rates. Their money comes back out to you at double digit prices. That gap is not an accident. You feel this every month, even if you never open a banking report. It shows up when your savings account pays almost nothing, but your credit card charges more than 20%. It shows up when your paycheck lands, sits in a checking account, and quietly becomes fuel for someone else's loan book. It shows up when one bad week, rent, groceries, gas, a surprise bill turns into overdraft fees, late fees, or revolving debt that refuses to die. And it shows up in the numbers. Total household debt hit $18.8 trillion at the end of 2025, while the household debt service ratio, the share of disposable income going to require debt payments, rose to 11.32% in 2025 Q4. That is the part most people miss. Banks don't need you to be rich, they need you to stay plugged in. Depositing, borrowing, swiping, paying interest, maybe paying fees. And if you're thinking, that's just how finance works? Yes, exactly. But to understand why the system feels so lopsided, you have to go back to the moment banking stopped being mainly about safekeeping and became a machine built to monetize your financial behavior at scale. That's where this starts. Banking in America was never created as a public service. It was created as infrastructure for commerce, credit, and capital formation. After the banking collapses of the Great Depression, the US built guardrails. The FDIC was created in 1933 and National Deposit Insurance began in 1934, originally protecting deposits up to $2,500. The message to ordinary people was simple: put your money here and it will be safe. That promise mattered. Trust brought deposits in, deposits gave banks cheap funding gave banks power, then the model evolved. By the 1990s, overdraft programs, once uncommon, spread aggressively, and the FDIC later warned that some programs imposed substantial fees and were designed to maximize fee income. By 2019, banks and credit unions were pulling in about $15.47 billion in overdraft and NSF revenue, according to the CFPB. Not from wealthy investors, from account holders making mistakes, running short, or getting paid at the wrong time. So the story you were sold was security. The business they built was spread: take deposits in low, lend money out high, add fees around the edges, then do it at scale. And once consumer banking became less about protecting depositors and more about optimizing revenue per customer, the system didn't just drift away from helping you. That's when it started working exactly as designed. Think of a bank like a water tower in your city. Your paycheck, your savings, your direct deposit, that's the water flowing in. Cheap, stable, predictable. Then the bank opens valves and sends that water back out as mortgages, auto loans, credit cards, business loans, and fee-based products. Here's the three-step mechanism. Step 1, banks gather low-cost funding. Even in March 2026, the FDIC's national rate data showed ordinary savings rates were still low relative to what banks charge borrowers. Step 2, they lend that money out at much higher rates. Credit card interest alone was 21.52% in February 2026. Prime lending rates were 6.75% in early April 2026. Step 3, they keep the spread. The FDIC said the industry's net interest margin, plain English, the profit gap between what banks earn on assets and pay on funding, rose to 3.39% in Q4 2025, the highest since 2019. Banks also reported $295.6 billion in full-year net income for 2025. That is the core truth. Your bank account is not the product. You are. But here's where it gets worse. The system doesn't just profit when you borrow. It can profit when you slip. And that changes how you should see every convenient banking feature from this point forward. Because interest spread is only layer 1. Layer 2 is fees. The CFPB found overdraft and NSF revenue was still $5.83 billion in 2023, even after a huge decline from $11.96 billion in 2019 among reported banks. The rule the CFPB finalized in late 2024 was expected to save consumers up to $5 billion annually, or about $225 per household that pays overdraft fees. That tells you something important. These charges were never trivial. They were material enough to change household budgets nationwide. Layer 3 is risk transfer. You're told banks are safe because deposits are insured. That's true, but only up to $250,000 per depositor, per insured bank, per ownership category. Anything above that becomes a different conversation fast. In 2023, Silicon Valley Bank failed with $209 billion in assets, and First Republic had nearly 70% reliance on uninsured deposits before it collapsed. So when things are calm, your deposits are cheap funding. When things get unstable, the public backstop matters. The losses, the guarantees, the emergency responses, those become systemic questions. Private upside, public stabilizers, and the headlines usually stop right there before they explain who really learned the lesson from all this. What most people don't realize is that the banking system is not primarily built to make you wealthy. It is built to make the system itself liquid, profitable, and stable enough to keep operating. Those are not the same goal. A bank loves your savings account for one reason. It is low cost funding. It loves your credit card balance for another. It is high yield income. It may even like your financial confusion because complexity creates inertia. People leave money in low yield accounts. People carry balances too long. People assume their bank is giving advice when it is really selling placement. Look at the split on the same dollar. In early 2026, many traditional savings accounts still sat around the low single digits or below, while some high yield accounts were near 4% and top offers reached roughly 5%. That means many customers were effectively subsidizing bank margins simply by doing nothing. That's the hidden truth. The biggest edge in banking is not superior intelligence, it's customer passivity. Banks don't need you to fail spectacularly. They just need you to accept mediocre terms for a very long time. And once you see that, you stop asking whether the system is fair. You start asking how to stop donating to it. Here's what smart money is doing right now. First, separate transaction money from wealth building money. Use checking for cash flow. Use a high yield savings account or treasury based parking option for emergency cash. Why? Because leaving large balances in low yield accounts hands away yield for free. Start by moving even your next 30 days of excess cash. Second, attack variable rate debt first. If you carry credit card balances, that 20% plus rate is a financial fire. If you have $500, use it to reduce the highest APR balance. If you have $5,000, consider a balance transfer only if you can clear it before the promo ends. If you have $50,000, prioritize eliminating all unsecured debt before chasing more aggressive investments. Third, stop paying avoidable fee income. Turn off overdraft if it protects you from accidental fee stacking. Set low balance alerts. Use one bills account and one spending account. Why? Because banks historically made billions from timing mismatches, not just reckless spending. Fourth, respect insurance limits. If your cash exceeds FDIC coverage, spread it intelligently across ownership categories or institutions. Safety is not just about choosing a bank, it's about structuring your cash correctly. Fifth, make your bank compete for your money. The moment you compare yields, fees, and credit costs, their advantage shrinks. Inactivity is their margin. Attention is yours. The banking system was never designed to help you first. It was designed to keep money moving, risk priced, and profit extracted. Sometimes that system is useful. Sometimes it is necessary, but it is never neutral. And in the next slowdown, the same machine that quietly underpays your savings and overprices your debt will ask for even more trust. So remember the real lesson. They don't need your money once. They need your habits forever. And the question isn't whether banking will affect your future. The question is whether you'll keep funding a game you still haven't fully seen.